IRS Form W-4R. This is the withholding certificate for non-periodic payments and eligible rollover distributions. So this form was created by the IRS, I believe in 2022 was the first iteration of it, and it became mandatory in 2023 and beyond. So this is the 2024 version. It looks very similar. Previous to that, you might be familiar with Form W-4P, which was the withholding certificate for pretty much all retirement plans. That one is still used, but it's for periodic payments, whereas this tax form specifically is the withholding certificate for two types of transactions: non-periodic payments and eligible rollover distributions. So in this video, we'll go over how to complete this form, and then we'll backtrack and discuss non-periodic payments. We'll discuss eligible rollover distributions, and additionally, we'll talk about some of the tax problems that exist with rollover distributions and how you can avoid those. So let's start at the top of the form. We've got our hero's name, John Q. Doe, his address, city, state, and zip code, social security number. So as a reminder, if you've recently changed your address, you should probably update your address with the IRS. You can do so by filing your tax return with your updated address. That will prompt the IRS to change it. You can also call. You can also file IRS Form 8822, which is the official change of address form. I'll put a link in the show notes for you for that reference. And then in part two, you're simply going to complete a withholding rate. So you have access to the marginal rate tables down in the same form and in the instructions. So you basically are able to kind of estimate what your marginal tax rate would look like, and then you can select the appropriate withholding for that. For example, if you're married filing jointly and you think that you're going to have about $500,000 of taxable income, then the default 10% withholding rate probably isn't going to work for you. You would be able to select something higher. So this is something that you can work with. You can do this by yourself. You can work with your tax advisor or your financial advisor for the different types of transactions. So there are a couple of limitations, and we'll go over them in each of the different transactions. So first, let's cover non-periodic payments. For a lot of people that are retiring or that have retired, that are withdrawing money from their IRAs, they might decide a certain amount every month, every quarter, or twice a year or so. So those would be periodic payments. You have a standard certain amount of money that you're taking out on a regular basis, and you would use Form W-4P for those. Non-periodic payments would be if you needed to take $50,000 out of your IRA, then that would be a non-periodic payment. Or anytime you have it set up to where you just simply on demand, take out money from your IRA. Those are non-periodic payments because they're not any predictable schedule. So when it comes to those, the default withholding rate is 10%. However, you can choose a different rate simply by looking at the marginal tax rate and applying a different amount. That's the entire purpose of this form. So the other type of transaction is what's known as an eligible rollover distribution. So that basically means if you wanted to make a tax-free rollover from your 401k or from your IRA into another qualified retirement account or another IRA, that's called a rollover. And what you would do is you would request a certain amount of money that you intend to roll over, you would to make this a tax-free transaction, you basically have 60 days from the time that the money leaves your account to the time that it goes into your intended account. So the default withholding rate on that type of a transaction is 20%. So here is the difficulty. Let's imagine you wanted to transfer $100,000 from your 401k into your IRA. This happens a lot of times, specifically with people that have decided to retire or change their retirement, move from one employer to another, and they don't want their old 401k hanging around. It's perfectly natural for those people to just decide that we're going to take that distribution and roll it into my IRA. So let's imagine that you do that with $100,000. You submit this to your custodian. They cannot accept anything less than 20% here. So that's the default. If you select a rate less than 20%, it's not going to be a valid transaction. So in that case, your plan administrator might not process it at all, or they might process it at 20%. But so, what would happen is you have a $100,000 distribution, you get a check for $80,000 that you're now supposed to roll over into your new account. $20,000 went to pay for your taxes. But if you don't find that $20,000 and put that into your account, then now you have a taxable distribution of $20,000. So if you're under the age of 59 and a half and you don't meet one of the exception criteria, then you can also have to pay additional taxes. You would file IRS Form 5329, which is the additional tax form. You would report that on Schedule 2, and that would come out of your tax return. You'll eventually get some of that money back because that $20,000 went to go pay your taxes. You'll report that on Schedule 1, I believe, or your Form 1040, and then it'll come out in your tax return, but not before you've paid taxes and calculated them on the actual distribution and possibly paid additional taxes. So that's not really a tax-free rollover distribution. It's almost a gotcha. However, the Internal Revenue Code does allow for you to avoid this simply by taking yourself out of the middle of the process. So in an eligible rollover distribution, you take the money from your 401k or your IRA, you accept the money, and then you send it on to the destination account. So you can do either a direct transfer or a trustee to trustee transfer where you have those two account administrators or IRA custodians. They do the transaction for you. And because you never actually touch the money, no taxes have to be withheld. It's a tax-free transaction, and you can rest assured that they are on each side of the transaction 100% accountable for your money. So it's not like your $100,000 will just get lost. So that would be a much cleaner way to do that. Of course, if you have $20,000 sitting around, you can remit that $20,000. You'll get it back when it comes tax season. So at the bottom of this form, you'll sign and date it. And that's basically all you need to do with this form. A couple of other caveats. One, if you want to change your election, you have to submit a new Form W-4R. You may have to submit a Form W-4R for different institutions. So if you have one on file with your 401k custodian, you might have to submit a different one to your IRA custodian. You can use the same form if you made a copy of it and you signed it, but you should probably at least have a different date. So, this form came out of the Tax Cuts and Jobs Act and wanted to put marginal tax rates next to the selection so that people have a better chance of getting a more accurate reading on this. So, like I said, there's a couple more details. It's not, but it's pretty clear cut. So, we do go into a little bit more detail on in our article, which you can find at our website. Simply hit the link in the show notes or go to our website, teachmepersonalfinance.com, type in IRS Form W-4R, and you'll see the article appear. If you like our articles, please subscribe to our newsletter. And if you like our YouTube videos, please subscribe to our YouTube channel. And as always, if you have any questions or comments, please post them in the comment section. I read those every day, and I try to research the best answer that I can. As always, thank you very much and have a great day.